Is record margin debt causing the mass run-up? And what does that mean for volatility? Now, these frankly concern me, actually. Let's dive into this right here. This investor credit in the market. All right, so investors have positive credit balances in the green or negative credit balances in the red. Obviously, the negative credit balances is what they owe. All right, so going back to 1980, now this is in billions. It hasn't been adjusted for inflation, but you can see, I don't think it takes a rocket science to see that we have monthly closes of the S&P 500, and we got total debt in billions. So back then we had, I don't know, what's that friggin', I don't even know what that is, a billion or something like that. That's not geometric. Anyway, I don't know what that is, but if that's 100 billion, and this is 500 billion right here, I guess that'd be, I don't know what that would be, a billion, 10 billion, let's say $10 billion in debt. And back then, the S&P was at 1980. I don't know what that is. But the debt grows till we have right there, current level. That's about 400 billion or so in total margin debt. And the S&P 500 grew as well. Record margin debt before that was right there, August 2000. Then kaboom. Not record, but higher margin debt right there. June of 2007, October 2000's kaboom. High margin debt right there, May of 2018. Remember it happened Q4 2018. Kaboom. And of course, that'd be in the 2020, but I don't know what to make of this. I don't like it. I'm not going to lie to you. I mean, leverage on real estate is one thing. But leverage is why we have higher price houses. But leverage allows you and me to buy your house. There's no other way around that. Because without leverage, i.e., 10% down FHA loan or conventional 20% down, we can afford it, man. No other way around that. But this, I emailed my man Michael Edisis because he's he's a mathematician extraordinaire who's also a market follower. And I said, what do you think? I mean, he's in Hong Kong, so I just emailed him this morning. But that can't be good, right? I mean, if you're leveraged to the hilt, and when the market starts falling, all these margin calls get called. I used to be on the Schwab margin. I remember literally a margin call. Hey, you got to bring money to the table or else we're going to sell you out. I remember one guy, we sold, Finn! He was madder than a bee in a bonnet. We sold his position. We had to. He had to meet his margin call. And he was madder than a bee in a bonnet because basically what happened, we sold him. Then a couple hours later, the stock performed. And he was like, you guys shouldn't have done that. I can't remember what it was. Look, dude, I forgot what it was, 35% equity or something like that. I just can't remember. Once it was 35% equity, once you drop below that, we sell you out. One sec. And we sold him, I think he had a tax hit, and then the stock outperformed after that. And he was like, you guys, I can't remember what it was. You should have called me. And we said, dude, we've been calling you. We've been emailing the whole thing. I'll never forget that guy. What a clown. I'll never forget that guy. Because I was mad. I said, dude, the whole thing was nuts. I said, if the market would have kept going down, we sold you out, you would have been like, you know what I'm saying? You would never have called and congratulated us or stopping your losses. But what happens is there's rules that govern this stuff. And once you start violating those rules, i.e. literally the brokerage firm cannot violate the rules. I mean, I don't know what it is. Maybe it's 50% equity. Once you drop below 50% equity, they sell you out. And what does that do? It cascades. So you're selling out of that stock, which inherently is dropped in value, in which to cause the margin call to begin with. So the sell of those stocks lead to more selling of more stocks, and it's a vicious cycle there. Anyway, so let's look at more. That can't be good. all this debt. So what's happening, of course, is the more the stock goes, but then the other alternative is the exact opposite. The more the stock goes up, the more you can borrow against the stock to buy more shares because you maintain your 50% equity. So, all right, so you have $1,000 stock and you borrow $500. All right, so you put up $500 cash, you borrow $500 to buy the stock. You're 50% debt to equity. All right, so now the stock goes up 50% value. So now you got $1,000 stock is now $1,500. Well, now your equity is 1,000. So your debt to equity or your equity debt to equity is like 33% at that point. So it gives you more margin ability. You can borrow more to buy more. Now it's at $2,000. You see what I'm saying? But the minute it drops back to $1,500, you're SOL. Then you got to sell to keep your 50% equity, debt to equity. Now it drops more because people selling puts pressure on the downside. And I'm sitting there thinking, so let's see some help. All right, so Lance Roberts, a real investment advice, analyzes margin debt in the larger context that includes free cash balance and credit balances margin accounts. Essentially, he calculates the credit balance as a sum. Okay, all right, so investor credit in the market, positive balance, right? And well, there you go. So that's the other way of looking at it. So we look at it like that, and then we look at it like this, exact same chart. This goes back to 1995, though. So the red is how much debt, negative balance. Negative balance does it. Look at that. It's like coordinates exactly with the markets. And basically, what happens is here's the. Oh, man, that's just look. Here's a fall. Well, that would make sense. Again, if the markets fall, you're going to have margin calls. You're going to have less debt out there, but it's going to create this vicious cycle in the down. We are potentially now past the longest bull market in history. The peak in margin debt preceded the peak in the S&P 500 closes by about 19 months. The peak in margin debt preceded the peak of the S&P 500 by about 19 months. Much longer than previous shifts prior to corrections. Margin debt is currently at its peak, as is the S&P 500. Can this mean the S&P 500 will continue to rise? There are too few peak to trough episodes to overlay this series to take the latest credit balance as a leading indicator of a major U.S. sell-off. This has been an interesting indicator to watch and will certainly bear close watching in the future. Yeah, I don't know, man. Yeah, it's weird, man. That's just weird to me. Margin debt in the S&P 500, real growth since 1997. So here's real margin debt growth, and here's the S&P 500 growth. I can figure this one out right here. Margin debt is in the red. S&P 500 is in the blue. So real values adjusted to present-day dollars. Okay, so adjusted for inflation, margin debt is down here at 800 billion. And the S&P 500 is, I don't get that. Adjusted for dollars, that's not inverted. So that makes it look like see, that should be the other way around. This makes it look like the margin debt is dropping. Actually, it's not. It's way high. No, I see what they're doing. They're saying when the margin debt's at the lowest, the S&P. No, actually, I don't know. When they're saying the margin debt's, you got to look. This is the margin debt on this side. So when they're saying the margin debt it's at the highest, the S&P 500 corresponds to its highest as well. And then, yeah, that's a weird chart. I get what they're saying. That's tough to follow. So anyway, let's look at some of the comments. Now, this was initially written in 2015, I noticed. And I noticed one guy said it was pretty interesting here. Because this is 2015 when that first came out, and they updated just right now. So I want to show you guys something. Margins required for short sales. All right, gotcha. Is there a breakout in margin debt versus the retail investor versus hedge funds? And it's got to be the heavy weighted towards hedge funds, but they don't break it down. Right here, Ben Vernazza said, if the Fed wants to reduce the punch bowl without raising short-term interest rates, why don't they just increase the margin requirement, say 50 to 55%? That sends a message which probably would cause the market to go down some, but not as much if they level the bubble to continue to grow. And that's in 2015 he said that. And this guy says, excellent point. Note that Reg T, which dates from 1940, has remained fixed at 50% since 1974. Prior to that, management of Reg T was an active Fed tool. Here's a fascinating article published by Boston Fed's New England Economic Review. This is the Boston Fed in 2000, October. Right here. We show that recent increase in margin loans to about 1.5% of the value of the stock market capitalization. That's in 2000. Recent increases in margin loans were about 1.5% of the entirety of the S&P 500, of the stock market, I guess. I'm not sure if it's total or the S&P 500, may not reflect a more intense use of margin loans. In fact, there's been no recent surge in margin loans relative to debt capacity and margin accounts. In short, while the quantity of margin loans has increased, the amount of dollars people are borrowing, the capacity to borrow against securities has also risen as a result of rising stock prices, like I just said. It is not clear that this exposes the financial system to more risk. Of course it does. Anytime you're heavily leveraged, is more risk. To repeat, that article was published in the fall of 2000. Margin debt had peaked in March of that year, as did the S&P 500. Over the next 2.5 years, the S&P would drop about 50%. But indeed, the question, the Fed intervention on margin was discussed in the April 2000 Wall Street Journal by Schiller. He said, should the Fed step in? Schiller said yes. But his view is countered by Bruce Bartlett. Remember, the conservative economist who now is a lib. Isn't that funny? Obviously, the Fed side with Bartlett. Yeah. Anyway, I got to read that article by Schiller because this does concern me. What do you do? I don't know, man. I mean, that's margin debt up another 3%, continues record trend. That's the 1990s. We were well into the boomer bull market that began in 1982 and approaching the start of the tech bubble. That shaped investor sentiment during that second half of the decade. The astonishing surge in leverage in late 1999 peaked in March of 2000. The same month, the S&P 500 hit its all-time high. Although the highest monthly close of that year was 5 months later. A similar surge began in 2006. The latest margin data. Let's think about what you would do about that. I got to think on that some. This does concern me. Not gonna lie, this does concern me, and I'm sitting there thinking, I don't want to be overly pessimistic. At the same time, we've had a nice run. I don't know. I just got to think this through. So hang tight and put your thoughts in there, and don't tell me buy Bitcoin. Don't tell me. And I'm not just for me. For other people who watch this stuff, put your comments in there. Don't tell me buy Bitcoin. Don't tell me go all in gold. Tell me what you are doing. If nothing, that's fine. If there's a reason not to be concerned by this, let me know. I'm open to it. And I default on the idea that earnings drive the S&P 500 because I know that's true. But earnings are a trailing indicator. All right, so we have trailing 12 months, TTM, and then we have future projected earnings. But future projected earnings don't account for things of government shutdowns and stuff like that. The new economy we're in. Now, we got to think this through. All right, let me know. Thanks.